Hey everyone, welcome to the pro forma balance sheet. So here we'll be creating a projected balance sheet for 2014. We're given the 2013 balance sheet and we're going to have to make some modifications based off of some planning and some assumptions. Now you actually can copy this into a table and then it'll open up a new file for you. Okay, I've already have my Excel here, but do note that you can do that. So I'm just going to copy parts of the balance sheet, and then we'll work on it. So we're going to start with the assets. Okay, so again, I've just copied the 2013 numbers here of the current assets and long-term assets, and we're going to figure out the adjustments that will be made. So in other words, any changes, we're going to sort of keep track of here. And then we'll get to our 2014 assets. So let's take a look at our assumptions or expectations. So what they want to do is they want to increase the plant, property, and equipment by $4 million. So we're going to go and add that. So we're just going to make a note here. This is just a sort of reminder for us that we're adding $4 million to our plant, property, and equipment. Okay, so we already know in our projected balance sheet, we know that that's going to be our new figure for equipment. Next, looks like we're going to grow our inventory by 30%. So if we go to our inventories, we know there's going to be an increase in 30%. So we'll take our inventory and we're going to basically increase it by 30%. So 1 plus times 1 plus the 30%. All right. Now let's move on to accounts receivable. Accounts receivable will grow by 20%. So we're going to go up here and we're going to account for the increase in accounts receivable. Wonderful. And finally, marketable securities. Okay, so these are very liquid assets. They can be sold quite quickly within a year. As you can see, they're right below cash. Okay, so they're really liquidable. Good way to get some cash is, so we're going to actually sell off these marketable securities. We're going to reduce it by 50%. So we're actually going to do a negative number here. And again, you can represent these changes any way you like. This is just the way I'm suggesting, but by no means you have to do it this way. Okay, so in other words, we're taking half of those marketable securities. Now, it's important to note that we're using it to help finance the expansion. So it's not going to go back into the cash. Okay, it's going to be used to pay this expansion, or at least help with that expansion. Of course, we need more money, and we'll talk more about that in a moment. Okay, but it's important to know it does not go back into cash. So assume all other assets will remain the same, or let's do that. So if we assume all their assets will remain the same, then there's going to be no change here. All right. No change to goodwill. Okay, so our brand hasn't increased or decreased, reputation, intangible assets. So we should be able to, well, this shouldn't change, or should change, sorry. We're going to now account for the addition of the plant, property, and equipment. Okay, so this should increase. So in other words, we've increased our long-term assets, and it looks like overall we've probably might have increased our current assets as well, but we're just going to add them all up. Okay, wonderful. So we do need to, let's figure out what our total assets are. So we're just going to write down our total assets. And again, if you do use the full balance sheet, you'll have all these done. Just need to sort of insert some new columns. So total assets for 2013, which we actually haven't figured out, or we should have already been given that information. Right, so our total assets was the 29 million. We can add it up, but we have the number, so why not use it? Okay. And our sort of our pro forma for the next year, what we project for next year's assets. given that increase or the changes, we're going to add our current assets and our current long-term, and our total long-term, okay? So you can see we do have an increase. So now we can move on to our liabilities. So we figured out our assets. Maybe I'll just pause it and get those numbers in. Give me one moment, please. All right, so I've got our assets in there. Hopefully they're all looking correct. This is the part where you raise your hand and say, I made a mistake. Unfortunately, I don't get that opportunity. That's okay. So let's move on to our liabilities. Try and line it up here. So again, I'm just taking these numbers here, okay, and I've moved them here. And again, those are 2013 numbers. And it's the same thing, I'm going to add the change, if any, and then we're going to fill out our 2014 numbers. There's not as much action here. The only thing we know that has changed is that the company will use long-term debt to finance the remaining expansion costs. All right, so remember, we reduced our marketable securities. We've paid off some of the expansion costs, but basically the difference in our assets is going to be the remaining costs. So if we go to our long-term debt, we know that whatever the difference that is still owing to increase our assets, we need to account for it in our long-term debt. So that's how we're financing it. Okay, we're not issuing out any stocks or anything like that. So we know it's all in long-term debt. Oh, not multiplying, we are adding. Okay, wonderful. So other than that, we should be able to move over our accounts payable. Those should all equal the same. Okay, so the only increase will be in our total long-term liabilities. Okay, so our other still remains the same. So when we total them, just have to account for these two. Okay, and we take our total liabilities. Okay, so we're going to add our total current and total long-term. Common stock is going to stay the same. And we can bring these down. That's not going to change. Okay. Okay, so when we add our total liabilities plus our owner's equity, well, we're going to take our total liabilities and our owner's equity, and hopefully it does balance. So let's punch in those numbers. Bear with me. Thanks for holding. All right, welcome back. So let's see how that goes. I've inputted the 2014 numbers. Excellent. And finally, the last question, they want to know, what is the additional debt? Well, we've kind of answered that, right? So the additional debt was that change. So we have to account for those new equipment and property, and we're going to do that by financing with that additional debt. Okay, so remember, they're asking for the additional debt. They're not asking for the total debt. Let's hope we get the right answer here. Excellent. Thanks for watching and happy financing.